Good day, everyone, and welcome to our ongoing series of quarterly market updates. And what a quarter it has been. The COVID Delta variant put a dent in market recovery. Our government is spending money like there's no tomorrow. The COVID-devastated supply chain is struggling to recover. Many workers are hesitant to return to work. Wages and inflation are starting to become a concern. And the Federal Reserve Board appears to be wishing and hoping that all of this is just transitory. We are not so certain. And now I'm going to turn this discussion over to the newest member of our team, Morgan, and she will elaborate more on many of these points. Morgan?
Hello everyone, I'm Morgan Hood and I'm an investment advisor representative of TTG Financial. I have an actuarial mathematics degree from Kent State University and I'm very proud to be a part of the team here at TTG. If you've been into the office in the past 4 months, it's likely that we have met. If not, then I look forward to the opportunity the next time you are here. There is a lot going on in the market and economy, so we wanted to give you a quick third quarter update.
It seems these days that there are more businesses with now hiring signs posted than those without. Where is the labor force? As of July, for every 1 job opening, there are 0.8 unemployed workers. The unemployed are telling businesses that they are no longer willing to work for what used to be the prevailing wage. Businesses are being forced to raise wages in order to hire employees to keep their business running properly. This pseudo-labor shortage we are experiencing is creating upward pressure on wages, and we believe this wage inflation is pushing us toward an inflationary cycle. We are always on the lookout for signs or indicators of a market move. One rate we keep a close eye on is the 10-year Treasury rate, which is seen as a sort of pivot point for the yield curve. As of recently, the trend is a rising 10-year Treasury rate, recently reaching 1.5%. Some researchers believe that if this rate pierces 2%, it could lead to a 20% decline in the NASDAQ market.
This is the shape of a typical yield curve. Long-term rates are substantially higher than short-term rates. An inverted yield curve could occur, and it signifies just the opposite. It indicates that investors believe that short-term interest rates are going to fall rapidly at some point in the future. An inverted yield curve is a very reliable leading indicator of an impending recession. It has correctly signaled 9 of the last 10 recessions. If the 10-year Treasury rate continues to push higher, it could lead to an inverted yield curve, which is something we will certainly be watching for.
Over the last quarter, the Federal Reserve Board has claimed this inflation we are experiencing to be transitory. Our feeling is that this may not be the case. We believe that the wage price spiral being created may lead to a longer inflationary cycle. Only recently did the chairman say, inflation is elevated and will likely remain so in the coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices. These effects have been larger and longer lasting than anticipated, but they will abate. The Fed's main job is to control inflation. This chart shows the 12-month percentage change in the Consumer Price Index. The Federal Reserve is forming a game plan to push it back toward a normal level of about 2%. As you can see, we haven't reached levels this high since 2008, creating even more cause for action for the Fed. We are expecting them to start tapering their purchases of treasuries and mortgages in the next few months. We anticipate this to be a slow change in an attempt to avoid a knee-jerk reaction from the market. Then, sometime later in 2022, we expect the Fed to start to normalize interest rates. In 2021 alone, we have seen over 50 new highs for the S&P 500. We feel that the market is long overdue for a correction. In the coming months, we expect to see volume increase and a clear directional move of the market to occur. In this market, if you wait until the downward move has started, then you are likely too late to respond. The stock market is trying to digest all that is going on. In the meantime, we are getting prepared for a market move. We've been doing some selling at the beginning of the year and recently tapering holdings. If the market goes down, we will be net buyers. If it doesn't go down, we will still benefit. We will never be all in or all out of the market. The selling that we did was not only to preserve the gains that have accrued, but to free up cash to take advantage of buying opportunities in the coming months. We have highlighted a handful of causes for uncertainty in the stock market right now. In addition to these, there is a chance of a government shutdown in the near future. Also, Congress's vote to raise the budget ceiling in order to continue to borrow could have an impact. Lastly, a black swan event is always lurking, ready to have an unforeseen effect on the market. All of this and more is accumulating to a lot of uncertainty, which the market does not like. Because of this, now is not the time to be aggressive. In our tapering, we have decreased our exposure, and when the move does come, we will take advantage of the opportunities we are dealt.
Clearly, there is a lot going on right now, and a lot could happen in the next couple of months. We are watching all of these possibilities very closely, and we have prepared based on our expectations. Please call us or stop in anytime with questions or just to say hello. See you soon. Back to you, Jim.
Thank you, Morgan, for that excellent review. So, we are prepared for a bumpy ride in the months ahead, but also ready to jump in and do some buying if the market should overreact on the downside. As during COVID, this is where we can make some of our greatest gains. So until the next time we see you, take care, stay healthy, and always remember that you are always welcome to stop by our office or call anytime.